JJ, the CPA is here. Let's go, let's go. Yeah. Money, 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 money. You know what it be. Tell them all I do is work, cause money never sleep. You never met a CPA quite like me. Nah.
JJ the CPA here. Hope you're doing well. We got a special edition of the JJ the CPA's Small Business Toolbox. I want to really expand on this. As a CPA practicing now for 30 years, I've got my own practice for 25. I'm in the trenches every day. I'm going to be walking through really the top 10 things that I work with my clients on how to reduce down their taxes. Maybe for some, it's down to zero. Okay, maybe for some. So let's get into this with this special edition of JJ the CPA's Small Business Toolbox.
The combination to money making, we got this. JJ the CPA is the master locksmith.
So if you didn't tune into my other live, let me buzz through the top 10 and then I'm going to come back and expand on them. Okay, so in terms of when we're talking about paying zero taxes, this is a culmination. Maybe it results in a zero. Having good advisors working with you, knowing your circumstances, planning and strategizing. If you just listen to a hokey video somewhere else or read a goofball article on how to pay zero taxes and it was 5 minutes long, you're not knowing anything. There's no simple way to do this. There's no secret to doing any of it. The IRS makes it all available to you right at irs.gov. A good tax pro with good experience, whether CPA or EA, or in essence, those that are around this should be able to guide you. What it does require is for you to be interested, you to know your numbers. If you don't know your numbers, you don't know your business. That is something that we hear on CNBC by Marcus, who has a show called The Profit, Profit. But if you don't know your numbers, you don't know your business. Number 10, be a real business owner in an LLC. So own an LLC. We're going to talk about that. Number 9, be an investor in a business. Why? We're going to talk about it. Number 8, tax efficient stock investments. How? We're going to talk about it. Number 7, have tax basis. What is tax basis? You guessed it. Going to talk about it. Number 6, put your vehicle in your business. Well, I heard I couldn't do that. Okay. What do you mean you heard? Just you woke up in the morning and a voice came up and said you couldn't do that? Let's talk about it. Number 5, pay your kids. Oh my gosh, what? You're going to pay your kids? Remember, as a certified public accountant, I have a duty to the public to not give you hogwash information. You, though, have to have a business and have an LLC and a real business, and your kids need to be doing something, whether it's modeling on a website for you and your business or working in it or emptying the trash. So if you're being a goofball, then you're going to come up with goofball results on your tax return, which means you're paying more than you need to because you're just going by what you heard, which is just goofiness. I'm tired of hearing that from so many different people. Number 4, max out your tax deductible retirement. I mean, this should be a no-brainer. We're talking about it. Number 3, depreciate tangible assets with special depreciation. What's tangible assets, right? Tangible assets, stuff you can touch. You're right. You can amortize intangible assets, but we're going to talk about tangible assets and the special depreciation. Number 2, own commercial real estate. Why? We're going to talk about that. And number 1, pay zero self-employment taxes by electing for your LLC to be taxed as an S corporation. Now, because this is a special, I want this to be somewhat of a standalone, but I just want you to know right up front, okay, when we're talking through this top 10 to pay zero taxes, again, it's a culmination of things. But what I want you to note here is that an LLC, a limited liability company, is your legal entity. It does not tell anyone how you're taxed. So an LLC can be taxed as a C Corp, an S Corp, a partnership. An LLC, single member LLC, doesn't mean anything in terms of how you're taxed because a single member LLC can be a C Corp or an S Corp. Now, it could also file Schedule C, Schedule E, Schedule F. Now, if you're like, well, wait a minute, how is an LLC taxed? An LLC is your legal formation. You elect how something is going to be tax. So that brings us to number 10, be a real business owner in an LLC. See, that's your first step in telling not only the world, your customers, your vendors, your employees, that you're a viable business and you plan to be around by legally forming it. Now, with the IRS, you then elect, well, how do I want to pay tax on the net income of this business? Now, I'll invite you to go back and watch episode 9 of my JJ the CPA Small Business Toolbox, because I walk through that quite a bit. And I'll give you a link to all of my prior episodes of this show that we do weekly. But what I need you to note, though, in terms of what is an LLC, how is it taxed, here's what I want you to know. If you're to this discussion, okay, you're a real business owner. And that means then you then get to enter into the discussion of, well, what do I get to deduct? And if you're a real business owner, and I don't mean to knock on somebody that doesn't have an LLC, because that might be more of a side hustle. It's something that you're doing in addition to your job. I know many that probably drive the Uber or Lyft, right? They're doing it as a side hustle, right? They don't have employees. They don't have a location. They don't have rent. They're probably not doing their own advertising. They're really doing it on behalf of that entity. But you're doing something on your own. And even if it is a side hustle, you should be thinking about an LLC. Plan for success, okay? But when you have an LLC and you tax it as pick whatever's the best for you, you now have the ability to take advantage of Code Section 162. That is the code section that is not available to those that are not business owners, okay? Code Section 162 says, if you have an expense that is ordinary necessary to your business and your intent in having that expense is for business purposes, you get to write it off. So when I have clients and they say, hey, I'm setting up a new business, will you let me know what I get to write off? I say, anything you're spending for the business, as long as you're spending it for the business. What does that mean? Well, what are you going to spend on your business? Because it's just automatically deductible, right? So if you're a dance studio and you're buying ballet shoes, well, ballet shoes would be deductible. Now, if you're a chiropractor and you're buying ballet shoes, I don't know how you deduct that, right? So I don't know that a chiropractor would be using ballet shoes in their chiropractic practice, but a chiropractor that's buying a table, they're buying a service to stream in music, or they're buying signage or advertising or sponsoring something, they're spending it, they get to deduct that. So they're then doing what? They're offsetting their revenue with expenses related to generating that revenue. And that's a way that you're able to save taxes. Now, if you spent all of your money on expenses, you'd pay zero taxes. You wouldn't have any money left. So if you want the hokey answer, right? You're like, well, I thought you said we're going to pay zero taxes. Yeah, spend all your money on your business. Okay. I don't know how you're going to spend it on anything else for you personally. Don't know how you're going on vacation or buying your kids shoes. Okay. But if you want to pay zero tax, bring in $100,000 and spend $100,000 on your business. You paid zero tax. That's hokey. That's not real. Okay. But what you do want to pay attention to is, what are you spending money on? And is it something related to your business? And if it is yes, have your business pay for it. Because see, the other key to Code Section 162 is that your business has to pay for it. So by having an LLC, has an EIN, and has a bank account, you've met hurdles that non-business owners are not going to. Let's talk about number 9, be an investor in a business. How does that save me taxes? Well, being an investor in a business, and what I'm talking about here, would be not with your financial advisor, right? So I'm not talking about getting into a REIT. I'm not talking about going into the stock market, not into bonds. I'm talking about you getting an investment opportunity, and you're now going to write a check directly to whatever this investment opportunity is, this LLC. So you want to have an LLC that you would put your money in, and then that LLC would own what it is that you're going to then ultimately have an investment in. Why? So you have a layer of liability protection. The other aspect is that you want to ensure that if there's going to be losses, that you're able to deduct them. You want to have, and we're going to be talking about it in number 7, but when you're an investor in a business through an LLC, you have then the opportunity that if there are losses, to be able to write it off. You're right. You could own and have an investment directly into an entity that then spits out a Schedule K1, and without you owning an LLC, you could potentially be able to deduct the loss just the same. But what I'm telling you is that it's better, and what my clients all do is they do not own direct investments personally, period, the end, because we want the liability protection for them. They want to own that percentage of the restaurant or the brother-in-law's HVAC company or the son-in-law's landscaping company or whatever the business is, right? They want to own a piece of it. Well, you need to have a liability barrier. That's why you have the LLC. Then the money goes in the LLC, then into the investment. But you now have losses potentially that you can deduct. Now, you don't want to get into an investment to have losses. So I've had clients in the past saying, hey, I want to get into this. It's going to generate losses. And I'd say, well, then find something else to spend your money on, because is this thing going to eventually make money? Are you going to get that money back? Because investing in something that's going to generate a loss that you don't get your money back, it's not going to eventually earn income, is in essence just throwing 10 grand away. Find something else to spend it on. But if somebody comes to me, most of the time when a business is starting, it's going to have losses in its early years. Why? Because that's startup costs. It's buying equipment. It's getting off the ground. It's advertising. Why is also a new business most likely going to have losses? Well, they haven't probably generated any revenue yet. And if they are generating revenue, it's probably going to go like this over time. They probably didn't start the business on January 1st, meaning it's probably mid-year. They don't even have a full year to get any revenue. So by having yourself invested in a business, and in the early years it's going to have losses, you would then be able to take advantage of those losses potentially, and they'd offset. Yes, you need a tax pro. If I got fellow tax pros tuning in, love you, appreciate you. You already know all the other things that go after that. But you have to talk about the first thing first, which is being a business owner and it generating losses. That potentially can then help save you taxes, or it can roll forward. At some point, it's saving you taxes. Am I right? Even if you don't have basis, it carries over. It's going to offset income in the future. Let's talk about number 8, tax efficient stock investments. So in this, I am talking about what you would most likely be doing with your financial advisor on a very sophisticated online brokerage house, right? So this would be me talking about your investment into the stock market, your investments into bonds. And this would be outside of your retirement account. So if you're in the stock market inside your retirement account, so inside your 401k, inside your IRA, inside your simple or SEP, there is no current tax consequences to buying and selling and interest and dividends inside your retirement. So what am I talking about? I'm just trying to make it super clear. Investments outside of your retirement that are not direct, they are in the stock market and bonds. So if you have gains there, first of all, that's smart, because those gains typically are going to be capital gains if you've owned that for over 1 year. If it's less than 1 year, you're going to be stuck at ordinary rates, just meaning regular tax rates. But if you own it for over a year and you sell it and it's a gain, you have capital gain rate. Did you know the capital gain rate is actually 0% for tax rates at the lower end of the brackets? Then it's 15% and then it's 20%. But it's definitely lower than ordinary tax rates. So bottom line is, if you're in the lowest tax ordinary rates, then you're paying 0 capital gain rate. That's already a win. But the other benefit to capital transactions is that if you have losses and they're realized, meaning you've sold the investment, those losses can offset your gains dollar for dollar. That's in essence something that can really be tax efficient. So what you have to think through and what you have to not be is just closed-minded and only see it this way. Now, what I want you to hear, okay, and I know that if you tune into my channel, you're not a dodo, okay? But don't think of this as I'm telling you to have stock losses. But if in the advice of your financial advisor, like, you know what, you have this investment in this stock and you know what, it's dipped. It just doesn't seem like it's going to come back. I mean, it just seems like this is what it's going to be. Maybe it gets worse. you don't have a realized loss until you sell it. So you may look at it and go, well, I don't want to sell it because I don't want to have a loss. You already have a loss. It's already a loss. It's just not realized because you haven't sold it yet. So what you have to get past is, well, I don't want to have a loss. And the reason I'm doing this is to go look at it full-eyed because you have a loss. You just haven't sold it to realize it, but you have a loss. You went in at 1,000, it's worth 500, okay? You have a $500,000 loss. Whether you want to admit it or not, the stock is down $500, it's a loss. So if you don't see it rebounding and you sell it, and now you have that loss can offset that capital gain. Now, when we're talking about this, that's where that money that you're investing in the stock market and over a year in capital gains, I just want to note to you, that's also when you invest directly in a company. So when we were talking about it in number 9, and I was saying be an investor in a business, you get that same treatment when you put money directly in, own it over a year, and then if it sells, you have a gain, it's capital gain. So when you say pay zero taxes, well, capital gain rates can be a zero. I do know this. We had clients that during the pandemic, their year was low, they had losses. They sold things at capital gains and paid 0% because they otherwise had losses that were offsetting their other income. They're at the lowest brackets and they paid zero tax. Or if you have a business and it's low, what does this require? Tax planning, tax strategy. What does that require? Working with your tax professional on this. All right, let's go now to number 7, having tax basis. Tax basis is this, having skin in the game. So tax basis, in essence, is your cost basis. It's called tax basis because that is, in essence, the skin you have in the game to take advantage of any losses. So tax basis definitely comes into play if you own stock in the stock market or bonds, meaning what did I buy it for? That's my cost basis. That's my tax basis. What did I sell it for? I get to offset, and the difference is what I pay tax on or take as a loss. But when we're talking about the direct investment, so I told you on number 10, be a real business owner and have an LLC. I told you in number 9, be an investor in a business. I told you in number 8, to be a tax efficient investor, right? Which all leads to number 7. So now let's talk about your direct investment, right? This is your, I know the person where they are. I've invested 10 grand, 50 grand, right? It's not through the stock market. It's not through your financial advisor. For you to be able to take advantage of losses, you have to have this tax basis. So you put 100 grand in, you have $100,000 in tax basis. So if it has a loss allocable to you, let's say of 140,000, you would be able to deduct 100,000 of that loss in that year. 40,000 would be carried over to the next year to offset future net income of that investment. So with that being said, if you didn't have tax basis, meaning you got put into an investment, you don't put any money into it, and it has 140,000 loss, you're not going to be able to deduct any of that loss in that current year. It would carry over to a future year to offset future income. Now, let's make a very distinct, different note here that with tax basis, we're really talking about S Corps and partnerships. With a Schedule C, a Schedule E, and a Schedule F, this is not part of the discussion. With a C Corp, it's not part of the discussion because that is an entity that pays its own level of tax. So when we are talking about tax basis, it's only an S Corp and only in partnership. Now, money in, right? That gives you tax basis both in an S Corp and a partnership. Now, with an S Corp, very distinctly different from a partnership, if you sign off on any loans as the owner and the loans are in the S Corp and you sign off on it personally, it does nothing to help you for tax purposes. Just know that. It does nothing to help you. If you have an LLC taxed as a partnership, or you just have a partnership, and there are loans that you personally sign off on that are in that partnership, in that LLC, then you have what's called at-risk basis, which is in essence the same as tax basis, meaning you now have upped your skin in the game. So in that example I told you earlier, if there's a $140,000 loss allocable to it, and you put 100,000 in and you signed off on a loan for 100,000, you would be able to take 100,000 of that loss to the extent of your tax basis, and the rest of that loss, that 40,000, to the extent of your at-risk basis. And then you would have, in essence, still 60,000 of at-risk basis. So think of it this way. Basis is skin in the game. So if you're getting into investments and you have skin in the game and they have losses in the beginning, remember what I told you about why does a business have losses in the beginning, right? It just makes sense that they would. Startup costs as a minimum. Those things then help you. Now, it could be that you want those losses to carry over. So maybe you don't have tax basis, but can't go into every set of circumstances here, because what we're focusing in on here is a culmination of tax planning, tax strategy that helps you pay the least amount of tax, no more and no less, your fair share, right? Right up to the line, doing everything properly. So as a CPA in 30 years, right? That's me knocking. That's me knocking. That's me knocking. Okay. I've never had an audit adjustment on a tax return that I've prepared. I've gone through audits, but I've never had an audit adjustment. All to try and tell you that get good advisors, use this information to take to them and do planning. Use this to spark some of your ideas and interest. Be more interested in your taxes than your advisor. Okay. They're your taxes. It's your money. Be more interested. Do not expect your advisors to be more interested in your taxes. They're interested, very interested, but you have to be more interested, which means that you need to push your tax advisors to put together strategies and plans, but you got to ask questions. Now let's go to number 6, put your vehicle in your business. This is when I had a little fun, and you hear often like, oh, well, I heard that you can't put a vehicle in your business if it's blah, 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 blah. I was like, I'm having fun, but I say this to my client, like, well, where did you hear it? Is just the voice from the clouds? Like, what do you mean you heard? Like, what does that even mean? Well, I was talking to the guy that was putting in the drainage, and he was telling me about his vehicle, and he couldn't put what? Right? Do you go across the street when you have a toothache and ask your neighbor to yank it out? Right? Hopefully, you're still not going to your mom saying, "Hey, can you give me a haircut?" Right? You're going to a professional, right? So, with this being said, deal with your professional. If you have a professional and they're like, "Oh, you can't put a vehicle in your business," then challenge them and say, "Can you tell me why?" Okay, you just tell me why. Because here's the thing, you know how simple it is? So if you have an LLC, okay, you want to title it in the LLC name. Now, I'm going to give you an exception. I got a video. You can go check it out. I go like this, and it's the big vehicle deduction, came out in December. Right? So if you're a sole proprietor, you technically don't have to have that vehicle in the LLC name, okay? But you probably should consider why you're not, okay? But let's just go back to you have a vehicle that you're using in your business, okay? My clients have LLCs, whether they're filed Schedule C, an E, an F, S Corp, partnership, or a C Corp. They're in an LLC. I don't work with clients that do not have their business in an LLC. And if they have any assets that they're using in the business, they're going to be in the LLC name. See, I don't work with the kind of client that's like, well, that seems like a lot of effort. I don't really want to go down there and have to title it. And I got to wait in line for 45 minutes. And I say, it's not worth the effort for 45 minutes and $25 title transfer fee to save $10,000, $15,000. Leave. See ya. I don't have time for this, right? So there's no shortcuts in doing things properly. There's no shortcuts in saving taxes. Well, I want to save a lot of taxes, but I don't want to pay a lot of money. Somebody show me how to pay taxes. Then just go pay a lot of taxes. Just go pay a lot of taxes and feel like you won because you paid $800 for someone to prepare your S Corp return and your individual tax return. Congratulations. That return sucks. I'm just telling you right now, that is no good. The only way that's good is your mom's a CPA or an EA and a tax pro, and they gave you a price break. Okay. Now, that's not you listening, but for those that are tuning in, you're not a subscriber, know this. You're getting a little bit of JJ the CPA with a little bit of coach. And what's coach? Okay. Coach is now getting serious as we go into the last 5 of our top 10 here and getting real about things, right? And what does that usually require? Well, if you didn't grow up with a mentor or a coach or some kind of teacher that pushed you, okay, then you're probably not going to like the rest of this episode. So don't judge me on the rest of this episode in terms of how you like my channel, okay? because I'm a CPA. I'm a certified public accountant, pretty mild-mannered, conservative kind of guy. Okay, don't take conservative as in politics. I mean, conservative is like, I think I'll go with the special for the hamburger, right? I don't know if I want to invest in Guatemalan gold funds, right? To me, that's conservative. Okay. So with that being said, when we're now dealing with motivating somebody to actually take action, actually strategize, actually plan, okay? Those that just sit around and wait for their advisor to call them, those that, well, I don't know if I want to pay $45 to sit with somebody and have them tell me how to save 10 grand. For those of you that you're too busy, you're running your business. You got another phone call. You got another employee wants to take time off. You have a vendor that didn't get you that product when they told you and it's coming tomorrow. You have the credit card charge that you're not aware of. You have the customer that thought you were going to give them 2 for 1, but it turned out that you didn't give them that, and now they want a refund. You have the employee that is coming to you with, we just ran out of paper, right? And that's what a business owner is dealing with every day. So what do you need? Maybe you need a little bit of coach. So if you don't like someone getting in your grill, then thanks for tuning in. Please check out my other videos because I don't get in your grill. But if you need someone to get in your grill, you need someone, and I don't mean motivated like you're now going to run through a wall and you're going to make $1 million in the next 24 hours, hokiness. I'm talking about motivating to actually be somebody that is going to take more control of your business, your finances, and more importantly, your taxes. All right. So I'm probably not going to scream. If you tuned in early in the pandemic and early in those videos, there were some. I was in the middle of the night and I was screaming at you to be an advocate for yourself. Probably won't go that far. But when we're talking about the vehicle, okay, putting the vehicle in your business, you already have a vehicle, right? Most likely. I mean, I get maybe you're in a city and you have, other means of transportation, but most small business owners, they have a vehicle of some kind. Get it in your business. Why? Because the gas, the insurance, the repairs, the new tires, the window wash fluid, everything, cleaning it, like it's all now tax deductible. It's money you're already spending. See, that's why it's so key. You're already spending that. Get it in the LLC name. Even if you're a sole proprietor, you should have an LLC, sole proprietor filing Schedule C. Get an LLC, get an EIN, file Schedule C. I don't know why you are. It should be probably an S Corp, but nonetheless, do it for real. Okay. Now you're writing off all of it. Now I get it. Some are going to say, well, if I do an analysis and I drive a lot of mileage and all that, hey, guess what? You're sophisticated in your planning. Okay. And that's awesome. And I love it. And do your analysis. But what I'm telling you is it most of the time is going to come out ahead under current tax law to be able to get the massive amount. You're writing off pretty much the entire cost of your vehicle. If it's over 6,000 pounds, GVWR, gross vehicle weight rating, you can write off up to 100%. It's up to your business usage, but up to 100%. You spend 50 grand on a SUV or a truck that's over 6,000 pounds GVWR, you didn't probably pay 50 grand. You probably financed it. You might have paid, I don't know, 4,000 in payments for the year, but you're going to deduct 50 grand plus the insurance, plus the tag title license, plus the gas, etc. See, here's the key to real strategy. What are you spending money on already? And how do you then tax deduct it without being a shankster? Okay. Now I tell my clients, we're not going to do the smirk test, right? What's a smirk test? Well, I could write off my motorcycle. Get out of here. I mean, like what? How can I write off my motorcycle? You use it in your business. How do I use it in my business? The same you would use a vehicle in your business. Okay. But if it's like, well, I mean, I ride out on the trails on the weekend. So, well, what does that have to do with your business? So see, tax planning is, in my opinion, it's easy when I'm talking to business owners because it's what are you already spending money on that is related to your business? How is it a big mystery? It can't be a mystery. Okay. I bought cucumbers and I had them for a snack last night. Can I write that off? Is it related to your business? Did you have customers over and everybody had cucumbers while you gave them a presentation to tell them about what you're selling? Then yeah, you can write off the cucumber. But if you just sat there and didn't do anything except watch TV, no, not gonna be able to write it off. It's the same thing with the vehicle. Let's go to number 5. Pay your kids. Get over this, okay? Get over it, okay? Any advisor that has an automatic, you can't pay your kids, I don't believe in paying kids, it's not moral to play kids and all that, doesn't know what they're doing. And I don't mean to insult anybody, but you don't know what you're doing, okay? Now, I know there are shucksters out there, and I know there's shuckster videos. They're like, well, just pay your kid. I'm not talking about just pay your kid. What I'm talking about is getting real with your business, seeing your business for what it is. It's there to support who? You and your family, okay? How do you get your kids involved? Well, everybody goes like, well, I'm not going to pay my kids $20 an hour to go and empty the trash. I mean, probably in this day and age, you're paying $20 for somebody to go empty the trash. Why can't it be your kid? Number 1. Number 2, there's nowhere in the law, okay? Get rid of this little fantasy that you know the law if you think that this is not true, okay? There's nowhere in the law that says what you have to pay somebody or not pay them. There's no maximum, okay? How much is an ad for 30 seconds in the Super Bowl, right? $1 million, right? There's nowhere in the IRS code that says, whoa. Ooh, no. You can't deduct that million. Well, that's different. It's $1 million to pay for advertising. What's that have to do with the kids? See, usually people that I deal with, that's the tone of voice they have. And really what I want to do is take them by the grill and tell them, like, what are you doing? Get out of here. Just go do something different, okay? Go do something different and stop preparing crappy tax returns and walking around acting like you know what you're talking about. So how do you pay your kids? How do you pay an employee? It's that simple. How do you pay an employee? You give them a paycheck. You withhold taxes. It's subject to Social Security and Medicare taxes if they're 18 or older. If they're under 18 and you pay them out of a partnership or as a Schedule C filer or Schedule F, it's not subject to Social Security and Medicare taxes. If you pay them out of an S Corp, no matter the age, it is subject to Social Security and Medicare taxes. Guess what you just did? You just created a deduction, number 1. You know what else you did? And this is why the IRS just doesn't care. And anybody that tells you that the IRS cares, they're just lying to you. I'm sorry. You just created payroll tax. You just created payroll tax if it's an S Corp or they're 18 or over. What does that mean? So you pay your kid, let's just say it's 10 grand in a year, right? On W-2, that kid's going to have 7.65% withheld and 7.65% matched. You just created a tax of 15.3%. So you do want to do this one carefully. But if you have a parent and they're in the 37% tax bracket, heck, even in the 30% tax bracket, and they can deduct pay, whether it's to an employee or to a kid, they're saving 30% or 37%, whatever their tax bracket is. That kid, okay, now let's just go with college age and younger, right? May not have any other source of income. So we do know up to the standard deduction, which changes a little bit every year. I think we're at $12,800, but it just changes every year. It goes up an inch. Okay. On earned income, the first $12,800, okay, is not taxable, meaning it's just a zero tax rate. Okay. Well, that's just the law. That's the law. Everything was followed. Kid was paid subject to payroll tax if you're an S Corp and they're any age, partnership and Schedule C, Schedule F. If they're under 18, yes, it's not subject to the Social Security and Medicare, but it's still taxable. And then that kiddo, they got to file a tax return. Now, you're right. If they don't have a filing requirement because they didn't withhold any tax and they made less than $12,800 earned income, they don't have any other income, they don't have unearned income, you can say, well, they technically don't have to file a return. Great, good. That means you really know your stuff here. But my point is everything followed suit. So when we talk about paying your kids, how much would you have to pay Miley Cyrus? Give me somebody else, like depending on the generation, Amanda, like
Britney
Britney Spears, okay? What would you have to pay Britney Spears' baby? What would you have to pay? I don't know if Miley Cyrus has a baby. The Kardashians, right? They have the Kardashians. Everybody should know who the Kardashians are, right?
Yeah.
They have of every age, right? Old to young to babies, right? Do you think for 1 second your business can put a Kardashian on your website? Now, let's just be real for a second. Let's get real for a second. The answer is no. You're going to get sued. You're going to get a letter from their lawyer and say, take that down, right? You don't get to just take the likeness, the image of anybody and put it on your website or put it on your billboard or put it on your business card. Okay. So if you have the type of business that has a website and it makes sense and you have a billboard and you have the things and you're using advertising and you wanted to pay or you needed to bring in some models, you're going to have to pay them. I just mean like professional models. I'm not talking about models. I'm talking about just people that are going to have to pose. You're going to have to pay them, right? The IRS doesn't go, oh, whoa, 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 whoa. No, if they're related to you, you can't do that. Because if the Kardashians' baby, how much is that baby going to get paid for you to put them on the website? I mean, what do you think, Amanda?
Mm-hmm.
They're going to sit on a website for a year, Kardashian baby, what, $1 million?
Million plus.
Million plus, right? Now, let's get real. Okay. First of all, does your business have $1 million to pay your kid? Okay. So obviously the $1 million example is in essence to show you that kids get paid. And guess what? When kids get paid, the kid has to pay tax on it. The kid, Kardashian's baby, would have to file a tax return and pay tax on the $1 million. Well, that's not fair. It's a baby. It doesn't matter. The IRS doesn't care about that. So there is a person with a social security number, that income is to them. It can't go to the mom. The law does not allow mom to go, oh, I'll take that money. You just pay it to me. I'll pay tax on it. No, it's got to go to the baby. Okay. So if you did do this, everything's got to walk and talk. See, if you're just going about this willy-nilly, I saw a video for 5 minutes. He said, I can do it. Now I'm doing it. Right. Someone told me I have permission to do it. So now I'm doing it. That thing's got to walk and talk properly. If you had Kardashian's kid, what is there going to be? A contract. There's going to be a definition of the amount of time, the likeness, how many, can it be there for 12 months? It's not just willy-nilly anything. You need to have a contract related to it. And it actually needs to exist. There needs to be a website. There needs to be a billboard, right? So let's say that I have a client that we did that in the past, okay? And it's in a small rural town. What do you think that they would have to pay somebody in a small rural town to model for whatever these pictures are, right? Just shaking hands or, eating dinner or something like that, right? $500 a month or something. It wouldn't be a lot, but it'd be something. People don't just go, hey, you can take a picture of me and put it on your website. You don't have to pay me. Yeah. Just do whatever you want with my picture. Right? Especially with a kid. How much would you expect someone to pay you or your kid for your kid to be on somebody else's website? Let's get real for a second. First of all, you'd probably go tear them up if you just saw a website and you saw your kid on there. What are you doing? That's my kid. Right? And if you want my kid on there and I'm somehow going to allow it, you're going to pay something. Right? How much is that going to be? Oh, just $5. No, you're right. Let's get real for a second. Now I'm giving you an obscure example, but obscure for a business that has a website, that has a billboard, that is then professionally doing this and it's for business purpose. Why wouldn't that fly with the IRS? Okay. I just have one client that we've done it with. So if the IRS is watching, the statutes run on it, the kid is grown, come and challenge it because it all walked and talked and it's $6,000 a year. What is the big deal here? And you can go and find the website and everything because we kept it. There's no challenge. Okay. And if there is a challenge, IRS loses. Why? Because it was done properly. That's why. You know how it doesn't fly? I don't have a business. I just created a website that just has my kids on it because I'm proud of them. And I paid them $6,000 to be on my website. You're not going to be able to deduct that, right? What else? right? I'm not going to pay my kid $50 an hour. Good for you. That's your opinion. That is your opinion. Okay. But all that to say is the IRS doesn't have an opinion on how much you pay someone an hour. Oh, so you're saying you're going to pay someone $1,000 an hour? Maybe. Do I have any clients that are paying their kids $1,000 an hour? No. Right. I don't understand why we go to such extremes. I don't understand why it's such an emotional conversation whenever it's had, not with my own clients, but with other professionals. Like, what is the deal here? I'm not talking about child labor. Okay. But you decide what you're going to pay. Well, it needs to be fair market value. Good for you. That's your opinion. Okay. No, I'm not saying that an 8-year-old that empties a trash once a year gets a $12,000 check. Let's get real. But guess what? There's nothing the IRS could do if that was true. There's nothing the IRS could do that wouldn't allow you to do that. Now, why wouldn't I do that with my clients? Like, well, I mean, I don't know. To me, it needs to be something probably reasonable. What is it? My opinion, right? It's my opinion that I give to my client. They come up with an opinion, and then we decide what to do. So what's usually realistic, right? Kids come and work in the summer, right? Coop comes and work for me. I don't just say, hey, well, Coop, you're doing it for free. I didn't pay Coop $50 an hour, right? What do I pay other people that come and help me do stuff? That's what I paid Coop, right? There's nothing wrong with any of that stuff. Now, what do you say to people that their kids don't work at all? You know what? I don't have time for this discussion anymore. It's what I would say. All right. Now, let's go to number 4, max out your tax deductible retirement. Get over this right now. Not doing that. Meaning those that are not maxing out your retirement, get over it. Okay. Here's the only excuse I'm going to allow you to tell me that would make sense. Okay. That you didn't even make enough money to put the maximum in your retirement. That's it. Okay. Because this is one of the best deductions that you can take. Why? Because it's going to you. It didn't go to some vendor to buy a copier. It didn't go to some car dealership to get a car. It didn't go to the motorcycle dealership. It didn't go to the hotel. It didn't go to a third party. It goes to you. Why aren't you maxing this out? Well, I just don't think it's a good time to put money in the market. What? Hello. Stop. Boom. Knock that off. That's just an excuse. Because you can put money in a 401k, IRA, simple plan, SEP, and it just sit in a money market or just sit in the bank. If you're like, well, I don't even want to sit in the money market. I don't even want it to make 10 cents. It can just sit there in the account and say, I don't invest it. Don't put it in bonds. Don't put it in stocks. Don't do it. I don't believe in the market. And here's why. Now, the argument you can hear back is, well, what you've done is you've taken a deduction. You're getting it now, but now you've created taxable income in retirement. Well, that's true. But guess what? There's no way that even if you maxed your entire life, that most likely that's enough even for your retirement. I mean, when you really think about it, I wish that the 401k was like unlimited. I wish the simple plan was 50,000, right? You know, you can put money into SEP and it's pretty high, but most people don't do that. But my point in saying that is that we should be putting away the max to retirement and getting the tax deduction now. Yes, but most likely we know there's going to be tax in retirement. Most likely it's going to be less. Okay. Most likely. So you're saving more now. You're going to pay tax later. Right. So with that, no more excuses. Put it on automatic. Automatic, right? So if your max is X amount of dollars divided by 12 and have that go in, get it done, right? Got to have it through wages. This isn't something to wait on. If you're not familiar with what plan, I've got a video. You can check it out. Go with your advisors. Really the best way to go. If you're like, well, I've got to have a big meeting with my CPA. You don't. It's pretty simple, okay? Do you have wages? Yes, then your choice is 401k or simple plan. 403b's for the government. That's it, right? Now, on top of that, you can have a SEP, but all of those are based on wages. If you don't have wages, okay, then you can't do any of that unless you're a Schedule C filer. And then it's based on your net income. And guess what? Whatever your net income is determines the amount. Oh, you got, what's the max percentage? This whole thing about, well, I don't know if I should do a 401k or an IRA or a simple or a SEP. You're just like, I don't know if I want to go in the living room through the back door. I don't know if I want to go in the living room through the side door. I don't know if I want to go through the living room through the bathroom. I don't know if I want to go in the living room through the bedroom. Once you get in the living room, it's all there. You're not making a decision about, do I put money in Walmart or in the stocks or in bonds? You're not making that decision. All you're deciding is, what doorway do I go through? And you know what the answer is? The one that leads to the max. Well, I don't know what one leads to the max. It's just not that hard. All it leads to is excuses for you not to do it. So what are we talking about here? Top 10, how to pay less tax, how to pay zero tax. Okay. So if you're doing all this stuff, you might get to paying zero tax. You got to remember, there is a 0% tax rate. Now let's go to number 3, depreciate tangible assets with special depreciation. So when we're talking about this, okay, you hear code section in code section in code section. Here's all I want you to know. For small business owners, right? You definitely could do an analysis. Do I want to write this off over 5 years or 7? Do I want to take 100%? I'm just telling you right now, okay? I've been doing this 30 years, okay? It's rare that we're going to have this analysis, okay? When I'm dealing with a dentist, okay, and they're netting $250 and they're buying a $50,000 piece of equipment, we're taking it all up front, right? So what are the 2 upfront deductions? Well, this year you have bonus depreciation. This is in 2022. And you have Section 179. Each can yield up to 100% deduction. Now, there's 2 distinct things to note here. With Section 179, okay, it's 100% deduction. Yes, it's limited to $1 million plus, okay? But most small businesses aren't putting $1 million plus in. So when the question is, well, what is it, $1,050,000? Are you a small business spending $1 million on assets? So don't worry about it. The reason I'm saying that is that many small business owners, they start giving themselves excuses by, well, I didn't know if it was $1 million or $1,050,000. Okay, this is like my good buddy Lance. And when my kid was playing basketball with his kid, and they were, let's say, 2nd grade, okay, Lance's son asked my son, and we both overheard it, but he said, hey, is there dunking allowed in this league? Okay. I don't know what the footage was, but it definitely was nothing that could be dunkable, right? But then it's an excuse of, well, I don't know if we can dunk or not. Can we dunk? Hey, do you think we can dunk over here? You're just finding excuses not to actually do anything. So what you really want to try and figure out is this going to save me taxes? How do I do it? The more important thing is, it needs to be paid for by the business. It needs to be financed by the business. It needs to be, in essence, titled in the business if it's the type of asset that's titled in it. You got to think through that minutia so that you're actually able to write it off. Now, on that depreciation, I was telling you on Section 179, it's 100%. Now, if you buy over X, and see, the reason I'm not going to tell you all these other X's and all this is because it just provides confusion for you that you don't need and you don't care. So if you buy millions of assets, then yes, it starts to limit. So a tax advisor that tells you, well, you know, that may not be 100%. It might have to, but like, who are you advising? This should be small business owners. It's kind of no-brainer stuff. The other thing I want you to note, and it can be a strategy, and that is this: with Section 179, okay, you can only take the depreciation to the extent of the net income of the business. So we may have clients that we have them file a Schedule C. We don't have to worry about tax basis. It's in the initial year. We know there's going to be a loss, and we can take Section 179 to the extent of net business income. But when it's Schedule C, it's to the extent of also the earned income of the taxpayer. So it may allow for more depreciation. So that would be kind of in your initial years if you were thinking it through and planning. And now Section 179 could be taken more to the extent. On an S Corp, you can take Section 179 to the extent of net income plus the wages to the owners. So it can be beyond the net income. But see, it also can be a strategy, and Section 179 can help, because if you have a huge amount of depreciation and you go, well, we only have 100,000 of net income this year, but we have 200,000 of Section 179 immediate depreciation. A lot of times with clients, I may say, hey, you know what? Let's do Section 179 because we get 100,000 this year. It's going to zero out your net income. And then we have 100,000 that will carry over, and we can use that 100,000 next year. Now, the other one that gives you this 100%, this special depreciation, was called bonus depreciation. Now, I want you to note this. In 2022, it's 100% new or used assets in the business. In 2023, it's only 80%. In 2024, it's 60%. You guessed it. In 2025, it's 40%. And you're way ahead of me. In 2026, it's 20%. And in 2027, it's 0. So this is the last year of the 100%. What's the differences between the two? 100%, because it's new or used, either 179 or bonus depreciation, either one. The difference is the bonus depreciation can be taken beyond the extent of net income. It can create a loss. So strategy-wise, if you have other income and other sources related to your income down at the individual level, you may want that loss. You may want the depreciation into the, or more than the extent of the net income to offset other income. Now you got to have tax basis, which is what we talked about in number 7. So depreciate tangible assets. But what does that also require? You have to buy depreciable assets, right? So in the early days, I started my own CPA practice when I was 25, graduated college, and had just turned 21, and then graduated college like 6 weeks later, right? So I was a young pup. So at age 25, who hires a 25-year-old? Other 25-year-olds, which means that in the beginning, I was working with a lot of new business owners. And a lot of times what I would hear year end is, hey, so what do I need to buy to save taxes? And my answer was always, what do you need to buy? Meaning, what do you need to buy? You might be able to buy it before year end, but we're not going to buy anything that you don't need, right? Well, should I buy some assets? Should I buy a car? Do you need the asset? Do you need the car? Because remember, you're still going to spend the money. But strategy can be also with depreciation of, we're having a big year this year. Okay. We know we are going to need XYZ equipment. It's going to need to be manufactured or special ordered. We better get on it now so we can get the deduction this year. There can either be strategies, because you have to remember, when you're depreciating an asset, just like any other expense, really what matters is, was it something that was paid for that year? It could be cash, a check, could be put on a credit card, and you can also borrow the money. No, I'm not advocating to borrow the money. But what I'm saying is that the depreciation, the deduction that you're able to take doesn't have anything to do with the amount of money you paid towards it if you've done one of those things I just indicated. Meaning, you could go and buy equipment and not start payments on it till next year if it's in a note, like you borrowed it. Okay, not just, hey, I'll get you next year. That doesn't count. But if you have a note, you have a loan, line of credit, credit card, then that vendor got paid and now you owe the creditor. That's the deduction in that year. So many times you got a big year, like, hey, let's go ahead and do it, but I don't know that I want to spend all my money on the new equipment. Maybe we need to finance it. So many, many, many times, when it makes sense, economically makes sense for the business, someone has a big asset purchase, they're paying zero tax that year because of the depreciation. Okay. They're not going and buy it to pay zero tax, but there are times that you're like, man, you go and spend that $100,000, it's going to save you $37,000 in taxes. Now you spent 100 to save 37. So if you didn't spend the 100 out of your own money and you signed on a note, you're going to eventually spend the 100. That's key. Let's go to number 2. Own commercial real estate. Here's what I need you to know. Commercial real estate, you can take Section 179 depreciation on. You cannot take Section 179 on residential real estate. Why? It's just a law. That's what it is. Okay. You can take bonus depreciation on commercial real estate as well as residential. But guess what? There's no qualified improvement property on residential. Here's all I need you to know. When a client comes to me and they say, hey, I want to get into some real estate. Should I do commercial or should I do residential? I'll say, well, from a tax perspective, there's more opportunity for more upfront deductions with depreciation on commercial property, because with residential property, qualified improvement property doesn't exist, because qualified improvement property is only on non-residential property, and you can't take Section 179 on residential. So what I tell clients is, hey, if you're getting into an investment, residential makes sense. That's great. Do it. I'm just saying, if you're asking me from a tax perspective, there are no home runs, grand slams in getting into residential real estate. Where there can be a grand slam is with the ability to take advantage of bonus depreciation on qualified improvement property and bonus depreciation on anything else that has a 20-year or less life. So let's just walk through quickly on the commercial real estate, because really all you probably care right now is, well, what would I be able to write off? So let's just break down a commercial real estate. And I'm going to give you a real example, but I'm going to round the numbers. Okay. So I've got it written down. So I have a client and they bought a $550,000 commercial property. Commercial property, it's pretty clear. It's zone commercial, businesses in there. Okay. Pretty simple. So it's commercial property. Well, the first thing is we need to break it out into several components, meaning the cost. So they spent $550,000. Now we have to go, what did that $550,000 go towards? Well, we know it went towards land and the building. So land, as in the raw dirt, you don't get to depreciate. Okay. So it yields zero deduction. The things on top of the dirt, okay, excluding the building. So landscaping, sidewalk, driveway, parking lot, signage, flowers, grass, trees. All of those things are going to have a 15-year life. Okay. Now you can get in like, whoa, the signage is 7-year. You're right. It's going to be 15 or less. Okay. Why does that even matter? Well, if it's 20 years or less, you get to take bonus depreciation on it. You can also take Section 179 on it. These are called land improvements. Land improvements can be Section 179 and bonus depreciation. Boom. And if they're Section 179 and they're bonus depreciation, it's 100% deduction. Okay. So we've talked about land, zero deduction. Land improvements on top of the dirt, that's 20-year or less property. You can take Section 179 and you can take bonus, which means both of those things allow you to get 100% deduction. Now we go to the building. Okay. The first thing to note is that we're talking about the building. So we're not talking about carpet. We're not talking about light fixtures. We're not talking about things that you really could take with you, right? Those are fixtures, furniture and fixtures. Those things would typically be 7-year property, right? Built-in cabinetry that you could just unhook fairly easily and take with you, right? Can't really take a toilet with you, but you can take light fixtures. You can take these nice light fixtures that are on there. It's not part of the building. It's not non-structure or structural part of the building. Pretty much you're looking at 7-year property, maybe 10 on your tile or your carpeting. But here's all you need to know. It's 20-year or less, which means that fixtures are allowed for bonus depreciation or Section 179, which is 100% deduction. Then now we look at the actual building. So we have HVAC, we have the roof, we have security system, we have an alarm system. All of those things are 39-year property. But due to the PATH Act that did survive TCJA, not to get too technical, that is still allowed to be Section 179. Cannot bonus it because it's 39-year property, but you can Section 179 those components: roof, HVAC, security, and alarm. Okay. All those things, 39-year, you can do Section 179. Why can't you do bonus? Because it's 39-year, and bonus depreciation is only for 20 or less year properties. Now let's actually talk about the building. So the structure, right? The foundation, the corners, right? The metal, the things that are actually the structure, meaning without these things, that building falls. Without these things, it cannot hold the roof. That's the structure. Okay. That is 39-year property. Now, if you buy a building and it's in its existence, you buy it, then the non-structural is also 39-year. However, the big key difference here with non-residential property, meaning commercial, anything that you do to the structure, okay, that is not the structure, hear me on this, just hear me on this, then that is a qualified improvement property and you can bonus it or Section 179 it. It's 15-year property and you can take it 100%. So what do you mean improvements? What I'm saying is things that are not land, not roof, not HVAC, not the actual structure as in more metal to hold up the enlargement, putting in an elevator or an escalator. Those things are structural. So most of the time when a building is bought and then you go and you knock down a wall, that wall clearly wasn't structure, okay? And you're now knocking it down and then you're putting a wall a different area. That's all going to be really most likely non-structural. That is then qualified improvement property that then can be bonus. Now, there's a private letter ruling the IRS came out with, and this was several years ago, but know this, that when you then look at qualified improvement property, it's any property placed in service after the building was originally placed in service by that specific owner or buyer, right? So you don't get to look to the seller and when they put it in. But why am I telling you that? Carefully, with right planning, right? I won't let my clients get into a building and then before they buy it, incorporate all the qualified improvement properties. What I tell my client is get that commercial property and then you pay for the qualified improvement property. Because if you tell the seller, hey, you get it improved, you do all this stuff to it, and then I buy it, okay, all those immediate and recent improvements are not going to, in terms of the non-structural, be something that I can take an immediate deduction on. So that's where the strategy comes in. Also in the private letter ruling, it talked about when is something placed in service if it's new construction. Okay. Well, it's placed in service when the lease is signed. When the lease is signed, that's when a property is considered placed in service. No, it can't be when there's all dirt. Okay. So long story short, non-residential, meaning commercial, yields big deductions. You can't just go watch another video. I gave you some info. I get it. Even if you were scratching it down, you're like, man, I still got a lot of questions. Good. Take it to your advisor. Okay. Number one, and in closing, to pay zero self-employment tax, be an S Corp. I've already talked about this stuff. Long story short, if you're filing a Schedule C, you're netting more than 20 grand, you are paying too much in my opinion, taxes. And you should be filing an S Corp return. Get with a professional. A professional that tells you about an S Corp should be able to rattle it off to you in terms of how an S Corp works. They may still want to ask you some questions and go through some details to determine if an S Corp makes sense to you. But when a client comes to me, in 5 minutes, we're able to make a decision if something should be an S Corp or a partnership. Because there's never a question of, should I be an LLC? The answer is yes. End of story, period, the end, okay? Then it comes down to, should we be a C Corp? Never. I mean, are you going public? Yeah. Well, then I guess you should be a C Corp. Are you really going public? Like, what? You're not going public. You don't even have a customer yet. Because guess what? You can go to a C Corp anytime you want. The other aspect here is when you file an LLC, really, in my opinion, it's either partnership or S Corp. Partnership, you're not actively involved. That means you wouldn't have been filing a Schedule C. If you're filing a Schedule C, you don't really want to go to a partnership. Why? Because the net income is subject to self-employment tax just the same as a Schedule C. If you're filing a Schedule C, you want to go to S Corp. There's really only one choice. You go to S Corp. Why? Because the net income is not subject to self-employment tax. And for my fellow tax pros, EAs, and CPAs, yes, you're right. There does need to be some wage. But the wage is not necessarily the entire amount of money that's pulled out. The wage is not necessarily the entire net income. So you do come out ahead. That's why I said if you're netting more than 20,000, because if you're netting less than 20,000, you're paying about $3,000 max in self-employment taxes, that 15.3%. So for my fellow tax pros, you know that, well, client's going to have to file a separate return, payroll, processing fees, maybe some other expenses that go along with it, right? So they may not save all that much if they're netting 20,000 or less overall cost versus the self-employment tax savings. But you take a business that's netting 50 grand, okay? They don't need to pay themselves wages of 50 grand. They get to pay themselves wages of something less. And that's when they come out ahead, because wages are subject to the same tax. Wages are subject to Social Security and Medicare taxes. Wages, the employee pays 7.65%. Wages, the employer pays 7.65%. Add the two together, it's 15.3%. That's the exact same percentage as what a Schedule C filer is paying on their net. The difference is with an S Corp, the net is not subject to that, period. And the only thing subject to that tax is what you choose to be, right? So if I have a client, they're netting 50 grand, they're probably paying themselves 20, and they're taking distributions of 30, which are non-taxable, and therefore they're only paying self-employment taxes, otherwise known as payroll taxes, on 20 grand. If I have a client that's netting 100 grand, they're probably paying wages of 60 and distributions of 40. They're saving, in that example, 15.3% on the 40,000. You got questions from here? Great, go to your advisor. They should be able to walk through this with you and answer your questions quickly and shortly in terms of how it generally works. So this was a special JJ the CPA small business toolbox because I really wanted to deep dive. That's what this channel is about. That's what I am as a CPA that's a tax professional, been doing taxes for 30 years. It's all I've done. It's all I know. I'm in the daily trenches with my clients, dealing with their taxes. And these are the top 10 things that I'm doing with my clients, in essence, to reduce their taxes. And yes, sometimes with the right planning, the way things come together, they may pay zero taxes, right? So with that being said, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. Have a great one.
Never